Good afternoon, everyone, and welcome to Low Load Insurance Services' 7th webinar of 2001. The scrolling slides moments ago filled you in on the CE and other information that you need. If you missed any of that, just be sure to visit the education page on our website, llis.com, for more information. Today's webinar will last about 50 minutes, and we've got some time allotted for Q&A. And today's presenter is Jerry Skapyak. A little bit about Jerry. He's been in the insurance industry for about 20 years, analyzing, studying, and researching annuity products. And that's made him the go-to guy for advisors with clients who are seeking to ensure they don't outlive their savings. He's licensed for life and health insurance products, and even more important than his product knowledge, Jerry's real good with people. He's skilled at assessing their needs and the benefits that are most important to them, and then tailoring the right product to fit their unique circumstances. He's logistical. He's a problem solver. He's a successful leader and a sought-after speaker. And we know that annuities are a complicated topic, but Jerry's done a great job putting together a presentation that's spot on topic. He will take questions on screen at slides 15, 22, and 28. And then at the end of the presentation, he'll open the phone lines for verbal questions. So if you want to ask some verbal questions at the end, be sure you've used your audio pin to log in. And Jerry, let's take it away.
Good afternoon, everybody. First, I want to say we are experiencing some weather here in Tampa, believe it or not. And we do have a tendency to lose power from time to time here, so if that does happen, I apologize in advance for that. As Dina said, we have allotted a fair amount of time for questions. When I do these types of presentations or webinars, I generally do get a lot of questions, so we have built in hopefully adequate time to answer all questions. I will be stopping at various points throughout the presentation after various sections we go through to answer those questions kind of as we go through each of the various riders. All right, so let's get started here today. We have a couple of goals that we're going to do. First, we're going to cover what are referred to as living benefit riders. We're going to cover a guaranteed lifetime withdrawal benefit, a guaranteed lifetime income benefit, and a guaranteed minimum withdrawal benefit. These are not the only three types of living benefit riders you will see out there. They are what I consider to be the most common that I see coming across my desk and what are currently being sold. We will also cover death benefit riders, the three basic types of death benefit riders that are available out there. And then finally, we're going to talk about who should consider these products, who would these be appropriate for somebody to be looking at. So first, we're going to talk about the various living benefit riders. And the first thing you're probably noticing on the screen is that in the first two, we have guaranteed lifetime withdrawal benefit, and the withdrawal is highlighted in blue, and then guaranteed lifetime income benefit, and the income highlighted in green. That is truly what is the main difference between these two riders. One is a withdrawal benefit, one is an income benefit. They may sound similar, but they actually do function dramatically different, and we're going to cover those differences as we go through the products or through the riders. So first, why are clients purchasing these riders on annuities? Well, first off, they are being sold the riders. Nobody is really going out that I'm aware of saying, hey, I want to buy an annuity and I want this type of rider out there. Most clients don't even know they exist until they are being presented to them by an agent. And why are they buying these? It's because of the guarantees they're being told about. They're being told that there are guaranteed growth, and they're also being told they're getting guaranteed income, especially in today's market, especially the last couple of weeks and in the last couple of days even. Clients are looking for guarantees. When they hear that word guarantee, their ears pop up and they become more interested in what is being said to them. Unfortunately, I've noticed that clients are looking, because they're looking for these guarantees, they're only hearing what they want to hear, and they don't necessarily, they forget like the age-old lesson, if it sounds too good to be true, it is true. So with living benefits, we need to understand something. There are two different accounts that we see with living benefits. First, there's the actual account value. It's the cash account. It's the real money of the annuity. This is the money the client can spend. If they want to surrender annuity, this is what they're going to get. And then there's this benefit base. It's the funny money. It is nothing more than a number on a statement that your client's going to get. Over the years, I found that the easiest way to explain how these benefits work is to walk through an example. So we have a client who wants to invest $100,000 into an annuity. And let's just say they're being told they're guaranteed 5% growth. What is that 5%? Well, end of the first year, our client puts in this $100,000, and their account value is worth $103,000. So basically, net of expenses, the annuity returned 3%. So they have $103,000. But they're being told, I thought I was guaranteed 5%. What is that 5%? Well, that 5% is guaranteed on the benefit base or the funny money. So at the end of year one, that benefit base is worth $105,000. Year two comes along, stock market did really good. Our account value is up to $120,000. But our benefit base is guaranteed to grow at that 5%, so it's going to be worth $110,000. Now, with these riders, they have what's referred to as a step-up feature. What the step-up feature does is it says that on a policy anniversary, and it could be an anniversary, monthly versary, quarterly versary, daily, happens even daily in some annuities, but whatever the marker is for that rider, if the account value is greater than the benefit base, that benefit base will be stepped up to equal the account value. So in our example, at the end of year two, our account value and our benefit base are both going to be worth $120,000. Year three comes along, it's 2008 all over, or maybe it's the last couple of weeks. Our account value has dropped down to $80,000. But because they have this rider on this annuity, the benefit base is still guaranteed to grow at the 5%, so it's going to be worth $126,000. So at the end of year three, our account value is worth $80,000, and our benefit base is worth $126,000. But everybody likes looking at that larger number, $126,000. It makes clients feel good. My annuity is worth $126,000. But is it really? Well, that $126,000, the only thing it is used for is to calculate the income the client is going to receive. It is used for nothing more than that. Now, this is where we're going to start talking about our different benefits. This basic example I just went through applies to most living benefits and how the two different values are calculated and what they mean on the statements. Those numbers, that account value is the real money, and that benefit base is nothing more than funny money. It is just a number on that statement. So when we take a look at our two living benefits, we have a guaranteed lifetime withdrawal benefit. And what I want you to remember with this is that no annuitization is required. And with the guaranteed lifetime income benefit, this I, when you see that, it is similar to the immediate annuity. In order to take advantage of the GLIB, the guaranteed lifetime income benefit, the client has to give up control of their account value, turn their money over to the insurance company to take advantage of that higher value. And we're going to go through an example in a little bit about how that's going to work. But first, let's talk about our guaranteed lifetime withdrawal benefit. Well, with these riders, the client is guaranteed to withdraw a certain % of money every year for as long as they're alive. Typically, that % they can withdraw is based on the age they are when they take that first withdrawal. If it's a joint policy, so a husband and wife, it's based on the age of the younger of the two. Here's an example of one annuity that's out there.